Tertia Jacobs is a Treasury economist at Investec. She's been watching the announcement today. Tertia, good afternoon to you. 25 basis points increase. Inflation still higher than it's supposed to be. Has been coming down. Is it the right decision?
Stephen, I think so. We have seen internationally, central banks have started to moderate the pace of rate hikes. Global inflation seems to have peaked. So many central banks are beginning to monitor the lagged impact of the cumulative rate hikes that we've seen since last year. So in South Africa, we think the inflation rate has also peaked in the middle of last year at 7.8%. December's reading was 7.2%. And we expect from January that inflation will start to moderate. And then when you add to that the big downward revision in Reserve Bank's GDP growth because of load shedding, I think it was the correct decision.
That GDP revision, was it just 0.3% this year? That's what they expect the economy to grow by? I mean, that's a tiny figure. I mean, it basically means it's not moving.
Exactly. The original forecast was 1.1%. So with the intensification and the lengthening of load shedding, the Reserve Bank estimates that this type of load shedding profile can shave off about 2 percentage points of GDP. So without this type of load shedding, we could have had growth in excess of 2%. But considering that, the spillover effects are from small businesses, on consumer spending, on fixed investment, they're looking at 0.3%. It's very difficult to estimate because we don't know to what extent Eskom will be able to reduce load shedding from stages 5 to 6 to a more type of permanent load stage 3. So it's very fluid, but the electricity situation is really very of major concern to us.
The other big variable, I suppose, is whether people are adapting to load shedding, by which I mean companies covering themselves and their headquarters in solar panels. Some can, some can't. Heavy industry can't do that. Banks, Tertia, probably can. Are we seeing a lot of adaptation? That must be very difficult to assess at the moment.
Yes, so it looks like, over the past couple of years, there has been an increase in the efficiency of electricity use. For example, changing to more efficient bulbs, that kind of dynamic. There's definitely a big move towards solar, especially rooftop solar. And I think the bigger companies, some households can actually do that switch. We still need bulk electricity at the end of the day, but I think the big concern is obviously for the small business enterprises. It is very costly. There's a huge hit to cash flows. And obviously, it will, if you use generators, it's also you use more diesel. So, input costs will be more elevated. It's not everyone, and not everyone will be able to adapt.
Within all of this, there are other factors. I mean, load shedding is something that South Africa can sort of control, or can't. But things that are happening in China, we can't control. We expect more demand from China in terms of some of what we produce, some of our commodities. We can't always get those commodities to the ports because of the problems with Transnet, which are in turn caused by a Chinese locomotive company. At the same time, more demand and more economic activity in China will lead to higher oil prices. What impact is all of that going to have on us?
Stephen, so I think that's the interesting dynamic that's going to unfold during the course of the year. So during the first half of this year, in South Africa and the rest of the world, we will see a fairly sharp moderation in South Africa in inflation. So we're looking at inflation coming down from about 7.2% to possibly 5% by the middle of the year. So the big drivers there will be the base effects of the higher oil prices, of the increase in food prices last year that sort of work its way out of the system. But then the big question is going to be, where will inflation settle? So internationally, for example, in the US, will inflation head back to 2%, or will it be more sticky around about 3 to 4%? In South Africa, the Reserve Bank focuses on 4.5%. So will inflation go back to 4.5%, or will it be stickier around about 5%? And I think that is where the point that you raised, for example, what will happen to energy prices if China starts to consume more oil? Because we've already seen in the beginning of the year, the crude oil price was around about $80 per barrel, because that is where the concern about weaker global growth dominated. And the moment, there were more news about the Chinese reopening. Global inventory levels are quite low. The world price hopped to about $80 per barrel, right? And $88 per barrel. So forecasts are that the oil price can conceivably rise back to about $90, $95 per barrel. So that kind of dynamic will make inflation stickier in the second half. We're not going to back to 7%, but it all could potentially keep us further away from targets. And in the second aspect as well is the electricity tariff increases, what you've just mentioned earlier, in terms of how load shedding affects companies, what could happen to input costs. So all of that is going to feed into the bottom line. And I think, as we move on to the next MPC meeting, as interest rates peaked, but I think the debate is going to shift perhaps that interest rate could stay conceivably a little bit higher for longer than expecting aggressive rate cuts going forward in terms of how the inflation scenario can unfold.
Tertia Jacobs, thank you. Really appreciate the time and the analysis. A Treasury economist at Investec, and of course the developing story there around interest rates going up by 25 basis points, increasing the pain that you're under at the moment. One of the things the Reserve Bank governor spoke about was food price inflation. That, I know, having a big impact on you.